Hi, everyone. I want to thank you so much for joining us today for investor training with 1000 Angels. Welcome. It's great to have you here. We're so excited to be doing this May session from in quarantine and shelter in place, and to use this extra time some of us have to actually educate ourselves about my favorite topic in startup investing, startup valuations. So this month's session will actually be part one of our two-part session, Startup Valuations Explained. We're going to be getting into some of the details about the differences between how startup companies and public companies are valued. We're going to be going over some of the different valuation methodology that's actually used to figure out what early stage companies are worth, and also just to help you understand the valuation ranges for companies that are at different sort of stage of growth and size of round. So without any further ado, we're going to get right into it, and I will share my screen with you all. All right, great. So Startup Valuations Explained 2020, the 2020 edition, which is pretty exciting. So for those of you who have never taken one of my classes before, or maybe new to 1000 Angels, I'd love to introduce myself. My name is Erica Dagnan-Minahan. I am co-founder of 1000 Angels and Rain Ventures. I've actually been investing for over 14 years in seed and Series A stage companies. I have had a variety of other roles, both as executive director of Golden Seeds, managing director at Dream It Ventures, which is an early stage accelerator. And during the 14 years, I have invested in well over 100 early stage companies, probably quite a bit more than that at this point. And I'm really excited to share with you some of the lessons that I've learned and the experience that I've gained from making early stage investments during that time. So thank you for being here. So to dive into this, we really want to talk a little bit first about what caused early stage valuations to get out of hand over the last couple of years. And you've probably heard folks saying that, valuations were getting a little bit frothy towards the end of the 2010s. We see some articles here, startup valuations are skyrocketing, why? And there was a huge influx of capital into the private equity markets during the last decade, as well as a general sense that companies were interested in delaying going public, so would stay private for longer and allow those startup valuations to continue to swell before they entered the public markets. And of course, entities, the most famous one of all, like the SoftBank Vision Fund, which was, $100 billion, or is $100 billion fund, had loads of capital to deploy into companies to allow them to stay private and, unfortunately, in some cases, continue to burn capital for a long time before they needed to think about entering the public market. So, that was sort of like an interesting trend that I think has abruptly stopped. We'll see some of the positives of the current crisis in that there might be some culling out of waste in the capital markets and a little bit more of a focus on making investments really intelligently, rationalizing that capital towards companies that can get to cash flow positive before they enter the public market. So the 2010s were a really unique time from a valuation perspective, and we are probably going back to fundamentals and basics a little bit as we think about valuing companies in the future. So we can definitely expect valuations to contract, and we've already seen that happen with a couple of companies, within the last couple of months, completely to be expected. So not only has the COVID-19 crisis, created a situation where companies are a little bit more capital constrained and there is some contraction of valuations, but we also did have a lot of drama with some of the SoftBank and other large growth private equity fueled startups that had raised hundreds of millions of dollars, sometimes billions of dollars at excessive valuations that were about to precipitate a downturn. So we want to kind of look at what that means for the future, as well as some ways that we might think about valuing a startup in the downturn, and what we've actually seen in the market for deals that have gotten done. So how have the current market conditions actually affected early stage valuations? We're going to be talking about that today. Investors want to know, how can you correctly evaluate a startup valuation yet remain competitive, right? So it's kind of like, I sort of am likening it a little bit to, folks who are trying to go out to the Hamptons this summer. All of a sudden, all the rental properties are double their normal price, right? So, on one hand, you might say, oh, geez, it looks expensive, but on the other hand, if you're not willing to sort of pay the price, you're going to miss out. So we want to be able to evaluate startup valuations for appropriateness and for value, but to still remain competitive enough to be attractive and to get in on the deals that can provide us with the returns that we are looking for in our portfolio. So the way that we do that is a combination of things. So number one, understanding the basics of estimating a company's valuation, but on top of that, layering in the current capital market conditions. So our main job at 1,000 Angels is to monitor the current capital market conditions. And that means looking at, the thousands of investment opportunities that are out in the market. Companies, we generally focus on companies raising between 1 and 5 million, and then comparing them on a relative basis for the most appropriate risk-adjusted return. So it's not just based on, the company with a $4 million valuation is more attractive than the company with a $6 million valuation, but it's based on what is their potential, what is the potential future value of that equity, and what is the relative risk of executing that business plan compared to all the other things that we're seeing in the market to determine if something is appropriately priced. So we have that, which is direct, firsthand market information. And then what we'll be going through today are just some of the basics of how we estimate a company's valuation kind of outside of current market conditions. And you guys will be learning how to do that. So the basic guidelines that we'll be, reviewing will help you understand how we select deals and how we determine if they're appropriately valued, right? So we're looking for risk-adjusted return potential opportunities, which ones have the best risk-adjusted return. So that means that, we want to not only determine whether or not the company is appropriately valued, but think about it in the context of the capital market conditions for future funding, for exit, and how they will change over the next, sort of 36 months to 5 years to 10 years that you're potentially going to have a position in the company, and how we expect the company to be able to access the capital markets as they grow. The most important thing here is also to know how to weed out deals that appear cheap. And they can appear cheap, but not necessarily be good investments because they're lacking the proper team, they're lacking traction, or they're lacking product market fit. So how do we make sure to eliminate those deals no matter how they are priced? So, the first rule of thumb is that a bad investment isn't made better by lowering the price. I've certainly seen startup founders going out trying to do deals saying, oh, it's a $2 million pre-money valuation, right? A deal that's priced too low, just because it's not a great investment opportunity, number one, is not smart for you as an investor, but also number two, even if the company does end up being successful down the road, mispricing a deal to the low side can actually hurt a startup's chance of success. So we're going to take all these things into account to figure out how we can invest in healthy, viable startup companies that have a great opportunity for growth and high investor return. So before we dig into the details on the numbers, I just want to remind everybody, since we've got quite a few of the signed up folks in the room now, the sort of intro is over and we can dig into the meat, that we would love to keep this very interactive. And I know that folks are going to have questions as we go along. So please feel free to use the chat box, or preferably probably the Q&A box, to enter in your questions as we go along. And I will be sure to try and get everyone's questions answered. At the end of the session, we'll probably open it up for general questions and discussion. And I'll, maybe unmute some folks if you'd like to speak verbally to give you the chance to do that. So moving on, valuation guidelines, the basics. So this chart, I think, is really useful for anyone who's trying to just sort of like get a sense of how early stage companies are valued, because it is really confusing, right? So if we look at, starting with what is typically sort of the very first round of funding for most folks. And that would be kind of after the company has hopefully spent, a little bit of the founder's own personal savings, et cetera, to get the company off the ground, would be a pre-seed round. And in today's terminology, a pre-seed round is generally anywhere from $250K to $1 million. And it's, generally happening at a valuation of between $3 and $5 million. And, where exactly that happens is going to depend on some factors that we'll go over. Yes, Robin, the slides will be available in the recording. So, where exactly that's going to happen is going to depend on quite a few factors that we'll go over later in the presentation. But essentially, this sort of first $1 million investment tends to come from friends and family, often from accelerators, and from angel investors. And typically, a company at this stage is either pre-revenue or at a very low level of revenue, and that would usually be under 20,000 in monthly recurring revenue. So this is a company that's either pre-revenue with a potential for scale, or it's somebody who has potentially started a business that's, kind of at lifestyle business revenue range, but they're looking to scale and grow a larger investable company. So that's where we can sort of see pre-seed rounds being done. And the way that you want to think of it is that in any particular round, a company is typically offering somewhere between 20% to a third of their equity. So in this example, if the company's raising about $1 million or so, and they have about pre-money valuation of between $3 and $5 million, they're selling about a quarter of the equity, somewhere in that range. So the actual valuation of the company is very often a little bit of a function of the size of the round, as well as a function of what the business has actually accomplished to date. So that would be pre-seed. If we look at seed rounds now, which are, often called sort of like series seed. So this can possibly be the first preferred equity issuance that the company is making, or it still might be on some sort of a safe or convertible note. But this is generally a round of 1 to 3 million. This is the stage at which 1,000 angels will actually get involved as investors in a company. So we generally aren't getting involved in pre-seed, but once you get to seed, you're going to get, organizations like 1,000 angels, you're going to get micro VCs, seed stage VCs, and scout funds actually willing to write you checks. And by this point, the company should be somewhere between $20,000 and $100,000 in monthly recurring revenue. Not all businesses have a recurring revenue model. Like businesses that are looking for investment love to figure out how they can get a recurring revenue model. But we're just going to, sort of have this conversation from the perspective of, SaaS recurring revenue model type businesses. And, if people have sort of other cases of other types of businesses, we can talk about those separately. But sort of like traditional investable tech companies that are generating recurring revenue for a scalable technology product in whatever way are going to follow these general guidelines. And with that level of traction, you're going to be able to command a valuation of somewhere between 4 and 12 million. And as you can see here, the valuation range is still sort of a function of the size of the round, right? So these rounds are sort of 1 to 3 million with valuations of 4 to 12 million. Same thing, you're looking at giving up that sort of like 20 to 25% of equity in that particular round. And, the other thing to remember is that the further along your company is, the more capital you can actually raise in a particular round. So the valuation of the company is a function of the size of the round, but the size of a round is also a function of the valuation of the company. So if I've seen loads of people who have a brand new startup, and they're like, I want to raise $3 million because that's what I'll need to, get my thing to the end of the line. And it's like, well, if your startup can't be valued at 10 to $12 million, it's going to be very hard or nearly impossible for you to actually raise $3 million, right? Your startup sort of has to be at the point where it can command that sort of valuation for you to raise that appropriate size of round. I'm just going to check the Q&A box really quickly. I think I have one. Okay, I will have to get back to your question in a second because it's not letting me see it. All right, so moving on to Series A. These days, a Series A, which is definitely an issuance of preferred equity security, and if anyone is confused when I say safe versus convertible note versus preferred equity, we do have a whole investor training that is exclusively just on term sheets and securities. So you can get that off of our YouTube channel. You can get it off of our Zoom library of trainings. You can go back there and brush up on the difference between the different securities. But a Series A can be the first issuance of an actual preferred equity security. It's definitely going to be actual equity, and it's typically between 3 and 10 million raised, with valuations of somewhere between 10 and 30 million. In this round, you're now going to see VCs coming in, and the general rule of thumb for VCs is that a Series A, a company is eligible for Series A when they're kind of at around 100,000 in monthly recurring revenue. So that's usually like the minimum bar to get a Series A done. Certainly there are instances where companies have not met that bar, but for a typical company without any particular advantages, this is the rule of thumb. So that's really kind of like where your startup needs to be getting to. So if you're investing in a company, say in the seed round, and you're willing to, invest in that round with a pre-money valuation of $6 million, you have to know that that founder has a clear plan to get their company from where they are today to at least $100,000 in monthly recurring revenue in order to sort of get that next level of funding. So we want to think about like the milestones and the next place that we have to be. So let's say you invest in a Series A, and I would say on a risk-adjusted return basis, the Series A round generally provides the best risk-adjusted return to investors. So we love to be in these rounds for like really high quality, great companies. The next round, which is a Series B, you're now looking at fairly large check sizes, generally somewhere between 10 and 25 million. And you're going to see valuations between $25 and $100 million for a Series B. And these are, really sort of the primary bread and butter for traditional VCs. Usually to get a Series B done, you're going to be looking at about 3 million plus in annual recurring revenue. So the company, goes from around 1 million in recurring revenue, 1 million a year in recurring revenue from their Series A to about 3 million plus on their Series B. And then after that, usually, a traditional trajectory for a high growth company that's doing well would be that a Series C is going to be 25 million or more with valuations of 75 million plus. And here's where you're going to see the growth stage VCs, the private equity firms, get involved. And at this point, the company is probably doing far more than 10 million a year in revenue. So it's sort of important to kind of understand these different buckets and categories, because if the company that you're looking at like doesn't fit in well to one of these categories or doesn't like have a plan to sort of fit into these categories, it can be much more challenging to raise money for them. So, things are just easier if you kind of like fit into the potential bucket. So, from an investor standpoint and from a founder standpoint, kind of thinking about this pathway to growth will make it easiest for you to have a healthy capitalization strategy for your company. And I hope that this also illustrates to some folks, like I've seen, some companies out there raising on like, random crowdfunding platforms, companies that are like, oh, we have 0 revenue, but our valuation is, 25 million or something crazy like that. They're really kind of like stepping out. So, this is sort of just like a good guideline to sanity check any things that you might be considering or looking at, and we'll get into the further details. So this chart I really love. It's kind of like based on a version of a chart that I think Jason Calacanis put together last year. I made it a little bit prettier and also added my own spin on it. But what this chart shows you is kind of the general trend line in typical startup valuations and what pushes things above the trend line and what pushes things below the trend line. So things that are above the trend line are kind of going to be like valued a little bit more highly than average, and things that are below the trend line are going to be valued a little bit less than average. So the things that are above the trend line might be considered kind of like expensive. And sometimes things are expensive, but for a good reason, right? And things that are below the trend line are going to be considered sometimes a little cheap. But sometimes things that are cheap can be a really attractive deal. So, you know, between kind of like the idea stage and the growth stage, you're going to see companies go from sort of like minimum of a $3 million pre-money valuation, you know, all the way up to sort of like a $15 million pre-money valuation for early rounds. So these are like pretty early rounds. And we go from sort of idea to mock-up to MVP to having some pilots to generating that first, you know, couple dollars of revenue to achieving some evidence of product market fit to, okay, now you're kind of ready for growth. And the general valuation band for, you know, this early stage of company is between 3 and 15. So where you actually end up between 3 and 15 is going to depend on, you know, how far along you are with this on sort of like the x-axis, right, as far as the business's traction. But then there are some factors that can make you, you know, sort of push you above the line or push you a little bit below the line. And I'd say the one that has the biggest effect on pushing early companies above the line is, does it have previously successful founders, right? So, you know, if Elon Musk called you and said he was doing a startup, you know, you're probably going to give him a little bit on the high end of evaluation versus, you know, somebody who's never done a startup before. So number one, previously successful founders can add, you know, $5 to $10 million worth of valuation to an early stage company. Obviously, valuable intellectual property will help boost the initial valuation of a startup company. And then, of course, there's always been a premium on kind of like Silicon Valley or YC graduated startups. You know, I'd say the YC thing is kind of like the Harvard degree of a startup. It doesn't necessarily mean your company is, you know, that much better than other ones, but there's certainly a premium placed on it and they can command a higher valuation. Not only because the quality of the business is assumed to be better, but also because there's an assumption that they have better access to a network of follow-on capital. And some of the things that make a deal sometimes a little bit less expensive, which might be more attractive to you as an investor, is number one, if they're not from the Bay Area, LA, or NYC. So just like real estate, you know, companies that are not in San Francisco, LA, or NYC are a lot cheaper than companies that are in those three areas. So something to think about. We've invested in plenty of companies that are based in, you know, second tier cities. I don't want to say that in a derogatory way, but, you know, not these top three from a finance perspective that have been incredibly successful. And so there's definitely value to be found there. Another is female or minority founders. We all know that, you know, female and minority founders put together get, I think, about 2%-ish total of venture capital dollars. So you're certainly able to find a lot of value investing in companies that have those founders because for whatever reason, you know, they just have been a bit overlooked by the market. And, you know, that's certainly changing as I think more and more investors realize that there's alpha to be generated by investing in female or minority founders. And then lastly, consumer products companies, they just aren't valued as highly as technology companies simply because it is more challenging and expensive to scale them. It's not anything particularly against their eventual product prospects, but they usually take a lot of money to get to scale. And so the value from an early stage perspective is a little bit less. So I hope that chart was helpful. And then moving on, this chart shows you a little bit about the milestones that you need to achieve in greater detail at different stages. So when you're at $0 in revenue, you are kind of squarely in friends and family world. So at this point, you know, you need to build a team, you need to build a product, you need to be researching customers, and you need to be testing an MVP. So that is zero. You know, expect all your money to be coming from friends and family, and expect that if you are raising money from, you know, not using your savings, but taking in money, that your valuation is going to be kind of at the very lowest, so that $3 million range. By the time you get to that first $1,000 in monthly revenue, well, you know, you're not rich, the company's not rich, but, you know, at least it's providing something, which is great. And at this point you have some customer validation, you might have an MVP that's been validated, and you're going to be using whatever money you raise to build an improved product. Okay. So you're still in friends and family range, but at least, you're generating some revenue, and you might even be able to say like the difference between a 0 revenue and at least 1,000 is, a 3 versus a $4 million valuation. So from a founder perspective, it's meaningful. Try to get to those milestones. So moving on to actually being able to do a pre-seed round is a company that's generating at least 10,000 in monthly recurring revenue. So at this point, you've got some proof of concept, you're going to be building your customer acquisition channels, you're going to be finding product market fit, and your valuation might go up to sort of closer to $5 million. By the time you get to 100,000 in monthly recurring revenue, you've probably found product market fit. You've probably found some scalable customer acquisition channels, and now you're looking to find deep pools. So at this point, the company will be worth closer to 10 million. At sort of the 250K MRR standpoint, you're ready to scale. You probably have a repeatable sales strategy, and the company might be worth closer to 15 million. And then sort of true Series B, 1 million in monthly recurring revenue and on, you've got product market fit, you've got sales fit, and you've got customer acquisition fit. So your company is going to be worth more. It'll probably be worth, 30 million. So this is kind of like the value evolution that we want to expect from our startups, and it will determine their ability to raise follow-on capital. So one of the exciting things that I promised you guys we were going to talk about today, which I was super excited to get into, is the Giphy acquisition. So Giphy was just acquired by Facebook for $400 million, which is a lot of money. And you guys have probably used Giphy. It's like that really cool app that's in your keyboard, so that, if you're sending somebody a text message, you can just, enter in whatever word it is you need a gift for, and it's going to automatically give you a selection of gifts to choose for. So really cool company, really interesting product, but, also kind of a 2010 tech baby. So we're going to look at their fundraising history and their valuation evolution and think about, what did this mean for investors? Was it really a home run? Was it a base hit? Was it a failure? All right. So answers are to come. And it was really fun to get to sort of like break this deal down a little bit. And, I feel bad because like, this is one of my favorite topics and I already will talk forever. So like adding in any new stuff, it's probably going to push this session over an hour. So hopefully you guys stay with me. So let's look at their valuation and raise evolution. So their first, like pretty much first recorded round was a Series A, and this was back in 2014. Back in 2014, like people were still cool saying, hey, like this is my Series A. They would actually say, so that first round they raised would be called the Series A. Over the last however many years, terminology got weird. And so like this round, that they did as a Series A would now probably be called a Series Seed, just for optics. But back then they were cool with it. It was called a Series A. They raised about $2.5 million. And we don't know the exact valuation. We're just going to sort of estimate that it was probably done around a $15 million post-money valuation for the company back in 2014. And then, not May 2014, not much longer later, they raised a Series B, $21.5 million Series B. And you know what? I'm so sorry, guys. I had some sort of a mistake happen when I was putting the slides together, but it was actually at an $80 million post-money valuation. So the chart is correct. Where it says 150 is wrong. It was actually 80. So we'll just mentally note that their Series B in Jan 2015 was 21.5, and it has the correct number on the next slide. So apologies, don't be confused. But that's kind of like a common size of round, which is, they raised about $20 million at an $80 million post-money valuation. Once again, we see they sold about a quarter of the equity in the company. Then, a little bit over a year later, they go back to the capital markets. They raise $55 million at a $300 million post-money valuation. And then not much later than that, October 2016, they're back into the capital markets. They raised $72 million at a $600 million post-money valuation. This entire time, the company has generated $0 of revenue. So it's pretty amazing to show you kind of how forgiving the private equity capital markets had been, that this company was able to get to, $72 million Series D and $150 million in total capital raise without ever even considering generating a dollar of revenue. Shocking, right? Now, we do know that I think they decided to turn on the revenue spigot like somewhere like mid 2018. And as of sort of the last estimate in how much revenue the company was generating, apparently they were generating about $5 million in annual revenue. So it's definitely like not following, 100% our traditional valuation guidelines, which is interesting, but also ended up in some interesting outcomes for some of the investors. So we'll be talking about it. So May 2020, that is now, the company exited, acquired by Facebook. So they raised a total of 150 million, and they were acquired for 400 million, and they were probably on track to generate about 5 million in annual revenue when they got acquired. So interesting story. What does this mean for the people who actually invested? So was it a great outcome? And apologies for the error on the previous slide. This actually has the correct number around valuations for the Series B. So I'll look to this slide for the right one. So if we look at, the Series A, which was about 2.5 million, the Series B, which was 21.5 million, the Series C of 55 million, and their Series D of 72 million. They raised 150 million in total capital. And then of course we have the common shareholders. So who are the people who own the common? It's the founders, it's, people who probably, worked there, everyone who had to be involved with sweat equity to make Giphy happen. So if we think about it from their perspective, the company was created with $150 million in hard cold cash plus 6 years of the time, effort, and equity of all the people that worked in the company that retained the common stock. So what does it mean for each of these class of shareholders? And I'm going to assume that obviously all of these rounds were issued in preferred equity with a 1x liquidation preference. I'm further going to assume that they also were issued in preferred equity with a 6% preferred return, because that's just kind of like market. So just to sort of like let you know what is preferred return and liquidation preference. If for whatever reason, you purchase preferred equity and the equity is less valuable than, the price that you actually invested at, you have the option to just receive your investment back plus your preferred return, which is 6%, which is not great, but it's better than losing money on the investment. So we're sort of going to go, back to front, or sort of like last in, first out methodology of understanding how investors did on this deal. So if we look at, we go into the fourth column and we look at the Series D, there was $72 million invested at a $600 million valuation. We know that the company was acquired for $400 million. So in theory, the price that they paid for their $72 million in equity would no longer be worth, it would be worth less than 72 million, right? So the company is actually worth about a third less than the price that they paid for it. But because of liquidation preference, they're at least allowed to get their money back plus 6% a year for however long they held the equity for. So in this case, the Series D investors probably got back 88 million. So essentially, for those investors, it's pretty much a fail. They basically got a 6% IRR. So the company was, the money was kind of substantially at risk for, 3.5 years and didn't really do that well on them, but at least they're able to sort of meet their hurdle rate to investors. So they came out with what we would call a multiple of invested capital of probably about 1.2x and a 6% internal rate of return. So next we go back to the Series C folks, and they paid a $300 million valuation for their shares, okay, which is less than the 400 million, but the problem is that there has been dilution, right? There was this other 72 million in front of them. So the, sort of like net value of that equity is actually probably a little bit less. So in this case, same thing. When we take the 400 million and we have to first take the 88 to pay back the Series D, we're now left with 312 million. So it's actually going to be still more advantageous for the Series C folks who have had their capital outstanding for 4.25 years to actually just take back their liquidation preference plus their preferred return. So they would end up with about a 1.25x return on capital over 4.25 years, which is just a 6% IRR. So neither the Series D nor the Series C nor the Series D investors have actually done well in this deal. And we can see that they contributed the vast majority of the capital, right? They contributed, about $130 million to actually grow this business out of, the full 150 that was done. And they essentially did not make money. So now we look to the Series B folks who did a $21.5 million round at an $80 million valuation. Once we've paid back Series D and Series C, they can actually convert their equity, convert their investment into shares of common equity, and they would come out with a multiple on invested capital of about 3x, and that 3x would have been realized over an investment period of about 5.25 years, coming off with an IRR of 23%. Now, 23% IRR over 5 years for a Series B investment is not actually crazy home run. That's actually literally just what the expectation would be from the beginning. So the interesting thing about this deal is, as excited as people were and as big of a deal was made about it, and, as much of a complete home run you would have thought it was actually a pretty, these are numbers that, probably the founder promised on the first day. So it didn't exceed expectations or lower it. It's kind of one of the things that I like about it is that it almost kind of comes in exactly where you would expect it to be. So IRR for the Series B investors would be about 23%. And then if we think about those Series A folks, who I'm sure if you, knew somebody who said, oh my God, I was an investor in the first round of Giphy, their very first Series A round. I was in that. You're probably thinking, oh, dude, you're probably so rich right now. You did so well. But same thing, over the course of the 6 years, it was outstanding. They did about 11x, which gives a much higher IRR of around 49%. But in reality, 49% is the target IRR for, this stage of investment. So a company that looked to have a huge home run outcome, really actually for its first 2 stages of investors basically generated the expected rate of return. And then for its, the vast sort of capital majority of investors, the Series C and Series D investors, really generated kind of a big fat zero. So it's just a great insight into just kind of how well these companies have to do to be able to really sort of meet the investment, the IRR expectations of investors for these, sort of long duration investments. And then of course, we'll look at the common stock, the common shareholders are probably going to end up with somewhere around 150 million, which is great. And so that means about $25 million in compensation for each year that all the common shareholders, people who have been allocated common stock worked. And I'm not sure, how many people they had to issue common stock to, but they'll clearly be sharing that all. And, it's about a range of an extra $25 million in comp per year for the whole company. So kind of an interesting case study. And I'm just really quickly going to see if I can, right now I can see the questions. So we have one from Maddie, and he asks, ARR Series A question: for a company looking to raise 3 to 6 million with a 50K MRR today and ending year at 100K MRR, is that still a Series A or a seed and follow the 25 dilution? Yeah, I think if you are at 50K MRR, that would be a Series seed. It wouldn't be a Series A really. So, you could do it either using a SAFE still, or you could actually issue preferred. And, you can probably raise $3 million on that. You'll kind of need to see it. It really depends on the type of company. But 50K MRR, and if your growth can support that, you would be at 100K MRR, sort of by the end of the year. I would think about it as sort of like a larger seed round and value appropriately. So if you're doing, a 3-ish million raise now, you could raise probably on like a $12 million valuation and you would be okay. All right, so next person from Anonymous, can you explain the dilution bit on Series C investors again, even though the eggs, right. So think about it this way. So he asks, why did the Series C folks get diluted? Even though the exit valuation was higher than 400. So think about it this way. When I'm the Series C person and I put my money in, right? And then I put my 55 million in, the post money value is 300. So great, wonderful, company's worth 300. But in between when I put my money in and when the company was sold for 400, somebody else put in a whole $72 million. So they have to get that $72 million back first, plus their preferred return. So they have to get back, $88 million. So by the time all of that is repaid, there's only 312 left. So between the time you invested and the company got sold, they only created like a 4% increase in value. They created a very small increase in value. So you're not, the company didn't really do better since you invested in your Series C. They just brought in additional capital. So that's kind of why the dilution affected them naturally. So, dilution's like not always bad as long as the company is using the money to create value. If they're, if they're raising $72 million, but, the company only becomes, slightly more about like $100 million more valuable after 3 years, like they didn't really create value. So, it's detrimental to your investment. So I hope that explains it. And, we have some sessions where we get into dilution, like a little bit more in the nitty gritty, because it is it's a complex subject. But just remember that every time additional money comes into a startup, so after you, it's going to create dilution, it's going to create leverage on the business, and it can potentially reduce your return. So I'm just going to really quickly check on the time. Okay, great. So I knew that case study was going to take a while. Thank you guys for sticking with me through the whole time. And I think we have one more question, so I'm just going to take a look at that. Oh, understood. You're welcome. So what drives value in investments, right? So we're going to, step away from kind of like current market conditions and just go straight into fundamentals. So the things that drive value are, number one, strong management team. And these are kind of like in order of importance. So strong management team, the size of the addressable market, it's got to be like at least $1 billion. Product market fit, the quality of your customer acquisition channels and how scalable they are, your competitive advantages or intellectual property, any barriers to entry, sometimes first mover advantage can help, traction and growth potential, and then of course, exit opportunities. So, one of the things I think that people miss a lot of times is, okay, you can build a great business, but like, is there somebody who wants to buy this thing at the end of the day? So we don't want to forget about exit opportunities. Who's going to buy this business so that you as an investor can get your liquidity out? So if we look at the first criteria, management team, how do they drive value? So we talked about it on the chart, experienced or serial founders. Several founders is always better than a solo founder. And the main reason for that is like, it's not like, oh, you're a solo founder and people don't like you because of that. It's because when you can actually build a team, and get other people to believe in your vision, it's just more likely that the company is going to be successful and that you're going to be able to recruit a further team and you're going to be able to build a really big business. And so having that team in place is super key. Generally, people are looking for at least 3 of the C-suite roles to be filled. And so the ones that need to be filled are CEO and probably COO. And then out of the other 2, you can either have both or you can have one, depending on what type of business it is. And that is either CTO. If it's like enterprise technology, it's got to be CTO. And if it's kind of like a consumer tech or, it's not really so like driven by the tech sort of business, it would be your CMO. So you're either going to look for CEO, COO, and CTO, or CEO, COO, and CMO. And then most importantly, relevant expertise, right? So they need to be able to answer the question, why this team? Okay. You see so many people who are like, I have an idea, but they have no idea how to execute it. And they think that somebody is going to give them money to hire other people to do this startup for them, and it's like, no, we need to know, like, why are you the person that, is adding value here? Why is this team the right team to be executing this business? Are we going to have to like pay somebody else to like help you figure it out? We don't want to do that as investors. And then of course, the last one is sweat equity, which is just, what have they built so far? So that's what we look for in team. As far as how addressable market drives value, you are generally looking for a $1 billion or more total addressable market. And, for people who are trying to start businesses in niche markets, it's like, listen, nobody's saying that you shouldn't start the business. It's fine. Go ahead and start that business. The caveat is that it just makes it not investable. Like, not everything is investable. There are lots of businesses that are great businesses that people do, and they make money and they pay for their kids' school and they buy, a vacation home and they go skiing and they buy the car they want, but it's not necessarily something that, is investable in nature. So for something to be investable, you really need $1 billion or more total addressable market, because that's going to dictate how large the company can grow. And that's going to dictate how attractive it potentially is to acquirers. So the possibility to get to 100 million or more in revenue is a check mark for something to be investable, and it needs to leave room for growth potential after the exit, right? Because like nobody, very few companies are getting acquired because the acquirer, doesn't think that they can now make this business grow more. So not only does the business have to grow large enough to attract the attention of acquirer, but there needs to be like room after the acquirer acquires the business for the company to become more valuable, right? That's why they're making that investment. So a growing total addressable market is great. And that's why you've seen people get really excited about like cannabis and video. Everyone's like got a TikTok now, Internet of Things, meditation, all these sort of like growing market sectors, are exciting because total addressable market can be bigger in the future. So my number one sort of valuation factor is something that we call product market fit. Why is it so misunderstood and why is it so valuable? So product market fit, very simply, is very simple. And this is a really easy way to determine whether or not something has product market fit. You send to all of your clients, how would you feel if you could no longer use, company product X? Very disappointed, somewhat disappointed, not disappointed, or like, I don't even use this thing anymore. So if you've done one of these surveys, you know why. The company is trying to assess its product market fit. And it is really, really difficult to actually come up with a result that almost everyone who takes a survey is very disappointed. So a company that has great product market fit, Slack, here's the example, this is the result of their survey. So they actually had over half of their users saying they would be very disappointed if they couldn't use Slack anymore. And another 40% saying they would be somewhat disappointed. And only 10% sort of saying, listen, I wouldn't really care. So this is kind of how high the bar is for a company to be successful. And where you see a lot of people lose money on investments is by investing in companies that have not yet met this hurdle. And what happens when a company does not yet meet that hurdle is that the startup you're investing in will spend all their money, all of your money acquiring new customers for growth. But because those new customers don't like particularly care about the product that much, they churn out, right? So now you've spent money to acquire a customer that's not, creating long-term value, and essentially value is destroyed. So product market fit is basically validation that customers actually value the product. This means that there is a possibility for monetization down the road, because if people are saying they're kind of feeling pain if they couldn't use the product, then they probably will pay for it, right? And because it's like, if there's no product market fit, you're really going to be spending a lot of money getting new customers on. And then, if you actually try to start charging them or, increase the price or whatever, monetize in some way, the users will simply churn out and the company will go under. So really like making sure that the company meets that hurdle, or even from a founder perspective, understanding that's the hurdle that you need to meet, I think will readjust your expectations about what makes something investable and valuable. And so if you do see a company that has amazing product market fit, that is a very good indicator that the company will do well in the future. So next is customer acquisition channels. You know, our rule of thumb is simple. You don't want to spend kind of more of the lifetime value, more than about a third of the lifetime value of a customer to acquire the customer. So, you know, if it's, you know, the customer is worth $30, they're going to spend $30 on your product. We probably don't want to be spending more than $10 to acquire the customer. So how this drives value is that, you know, the CAC to long-term customer value ratio is essentially the company's system or formula for making money. So if it costs $10 to acquire a customer that's going to spend $100 with the company, that company is more valuable than a competitor that has to spend $50 to acquire a customer who will spend the same $100. So the critical thing that we're looking for, you know, number one, after product market fit is understanding, does this company have a better, cheaper, faster way to acquire the customer, right? If a company that can get the customer for $10 is more valuable than a company that can get the customer for $50. So we need to think about that really seriously. The next thing that we need to think about beyond just the absolute dollar value of the CAC or customer acquisition cost is what is the payback period, right? So it's more valuable to have a company that acquires a customer for $10 and gets, you know, $50 upfront on transaction, right? Than a company that acquires a customer for $10, but has them on, you know, a $4.99 monthly subscription where, you know, it's going to take them a year to earn that, you know, that money back, right? So we want to think about the payback period. How quickly is the customer lifetime, or not customer lifetime value, but how quickly is sort of the return of invested capital happening? What is the payback period on initial investment? Ideally, it will happen on the first sale, but sometimes, you know, it might take a little bit more than the first sale, particularly for recurring revenue model businesses. But the shorter that payback period is, the more attractive the investment. And then, of course, we want to think about the impact of cost of goods sold or product margins. So, you know, when we're thinking about SaaS companies, there's very little involved there, and that actually drives up the value. When we're thinking about companies that actually have to provide a product or a service or provide a lot of customer service on top of their software, those are things that kind of like diminish the value. So an extremely long assumed customer life, right, means greater risk and lower value. If it's sort of if you're justifying the sort of payback period by the fact that, oh, I promise this customer is going to be around for the next 36 months. So these are sort of like, you know, up and down factors that we think about as we're determining a company's value. So moving on to our valuation methodologies and the actual math behind how we calculate these valuations, there are a few different ways that you can do it, and it's really done differently depending on the stage of the company. So at the seed stage, we use what we call sort of like deferred valuation or benchmarks. At the Series A, we move into benchmarks and the venture capital method. And the venture capital method is basically what we rely on. So that's what we'll really be talking about. At the growth stage, you're going to be looking at multiples of revenue. You know, investors are going to be thinking about, you know, acquiring a certain percentage of the equity. They might want, you know, more than 50% of the company so they can have a control stake. And then, of course, once you get to sort of private equity rounds, same thing, it's multiples of revenue. It's discounted cash flows and net present value of future cash flows. It's the value of the assets of the company. And then once companies go public, you'll get to, you know, probably most of you guys are familiar with valuation methodologies used in the public markets, which is like multiples, discounted cash flow, net present value of future cash flows, value of the assets, PE ratio, all that stuff. You know, the important thing to realize, like none of those things apply to early stage companies. So we can throw them all out the window for the early stage companies. Like, they're just not valued that way. And the sooner, you know, everyone sort of like learns that, the easier it is to operate in these early stage markets. So the underlying math for everything is discounted future cash flows, but how we apply it is a little bit different. So determining valuation is a bit of an art and a science. Like, number one, it's always a negotiation. And the important thing to remember is that, you know, at the end of the day, in the private equity markets, a company's valuation is set by a very small number of people, right? It's an agreement between the firm that made the investment or the individual that made the investment and the founder. Whereas in the public markets, you know, you have thousands of market participants that are helping to determine the price of a specific security. So this is really very much a negotiation. And it's also really dependent on the availability of capital in the market. So right now, we're going to see that a lot of like new startups that are trying to raise money are not going to be able to get deals done at any valuation. And that's because most investors have portfolio companies that are coming back into the market for additional capital to shore up their balance sheets to get through the financial crisis. So in a situation like this, where there's not a lot of availability of capital in the market, you know, you're going to see valuations go to, you know, the null set, right? Like they can't really go to zero. It's like, it's not happening. It does not exist. So I think for very early stage companies, for, you know, probably the next few months, it's going to be really difficult to raise capital. And we've seen a lot of folks sort of pushing off larger rounds until like, probably it's going to be about September before people really start being able to get stuff done again. But of course, if you are a portfolio company and you have existing investors, you will probably be able to pretty much successfully raise inside rounds at attractive valuations. So these valuations are determined by, you know, for the early stage deals, a valuation cap and a discount. You know, a preferred return for a private equity or a preferred equity deal, a liquidation preference for a preferred equity deal. So all of these different sort of factors influence, you know, the company's valuation. So there is the objective number, right? Okay, the pre-money valuation of this company is worth $12 million, right? But if the preferred return, right, let's say we're doing a, you know, $3 million Series A with a $12 million pre-money valuation, but the preferred return is, you know, 8%, right? That ascribes a lower valuation to a company with sort of like the same, you know, size of round and valuation, but has a preferred return of 6%. So there are kind of ways to like manipulate valuation with, you know, preferred return, with discounts for notes, with liquidation preference, you know, that sort of affect value of the security to the upside or the downside without changing the actual price. And usually when you're, you know, hearing about valuation for a company, they're kind of just giving you like the, you know, absolute price, but terms actually affect the valuation. And then lastly, it's really about meeting the entrepreneur's needs. So, you know, does the entrepreneur like you? Do they want you to be involved in their company and in their lives for the next 10 years? Can you help them? Can you provide great advice? You know, are you going to be there for them, you know, to support them when they are going through a crisis? All these things are what go into determining the valuation of a round. And, you know, this sheet I think is good just for, you know, people who are maybe new to valuations to just really clearly help you understand, you know, how we use our terminology. So there is pre-money valuation, there is post-money valuation, and then there is basically the new money. So the new money is the total money that goes into this round. So for example, here, you know, if we look at bullet number 1, we have a company that is taking in new money of $1 million. And the pre-money valuation that's agreed upon is $3 million. So this implies a post-money valuation of $4 million, and it means that the new investors own 25% of the company. So really simple. Hopefully everyone gets that. Moving on to sort of possible valuation methods for a seed round. We have benchmarking, which is sort of looking at recent similar deals, you know, which is what I call the sort of like cheating on your homework method. Looking at recent deals that are similar to establish a price. The Burkus method, which is kind of just like a back of the envelope valuation of up to $5 million. And then of course, what's, you know, traditionally used, we use the deferred method, which, you know, technically you still have to put in a valuation cap, you still have to do some sort of valuation, but you're allowed to use kind of like a safe or convertible note to defer the valuation until a priced round happens. So it'll have a cap, but it'll also sort of protect you, saying whatever the future valuation is of, you know, the next priced round, we're going to convert into equity at that price less some discount or a maximum of XYZ. So the venture capital method is really what we use. And I know we're going a little bit over on time today, and I apologize. I had a feeling that was going to happen since we added in the case study, but I want to make sure that you guys kind of understand the sort of theoretical calculation behind how we actually come up with these valuations. So for the venture capital method, what you're really kind of thinking about is the terminal sale value of a company that is estimated based on a multiple of sales or EBITDA, usually a multiple of sales, right? So we want to think about that. Then we need to add in the total amount of equity capital that's going to be invested in subsequent rounds, and that helps us understand what the dilution is going to be. Then the next step is that we will calculate an IRR based upon the number of years that we think that this company is going to take to exit. It's typically 3 to 5 years of projections that you're given, and the cash on cash return should be somewhere between 10 and 30x what you put in. So the question that we're kind of asking ourselves is, can the company sell for at least 10 to 20x the post-money valuation after our investment in the future? And if the answer is yes, then you're probably within sort of like the realm of possibility to actually get a deal done. So I think what we're going to do today is we are going to stop here because I want to be really respectful of everybody's time. But I also will really quickly open it up to Q&A. And I think what we'll probably do is set up our next session instead of a month from now. We'll probably do it like 2 weeks from now and finish the rest of the slides on this deck and maybe dive in a little bit into Startup Valuations Explained Part 2 during that session as well, with some more relevant real-time examples. So just want to really quickly open it up to the audience. If anybody would like to ask a question, they can raise their hand and I'm available for a few more minutes. All right, well, it looks like we have some shy folks today. We don't have any hand raising, but I do want to thank everybody from joining us today and let you know that if you'd like to learn more about early stage investing, and I do see a Q&A pop up, so I'll stay and answer this, but if you'd like to learn more about investing, please visit 1000angels.com. If you are an investor, you can sign up and start a free 2-week trial of 1000 Angels membership. We right now have about almost 8 companies that are currently open for investment on our platform, and quite a few of those are really successful portfolio companies that are coming back looking for a little follow-on insider investment. So we would love to be able to share those with you. If you're an accredited investor, you're absolutely eligible to try it out today. And if you're a founder looking to raise money, you can also go to 1000angels.com and submit your application for investment. And if you would just like to be on our newsletter list as well and get access to more exciting educational information, feel free to drop your email in there. And then lastly, if you love today's content and you want to learn more on your own time, and you can pause it whenever you want to, please visit our YouTube channel and check out our investor training playlist. We have lots of great content there for you to see. So I will get into these questions right now. Hang on a second. Okay, Zoom. Great. So first of all, we have some pretty simple questions. So somebody says, will there be a recording you can watch later? Absolutely. We will be putting a recording on our YouTube channel. So you can catch the recording at the 1000 Angels YouTube channel in the investor training playlist. And Maddie says, can you share the slides and valuation returns template? We don't actually email out slides, but certainly you can go through our recording and grab any information that you need from there in the future. So hope that helps. And then we have one more question. Anonymous asks, what is the safe method So a SAFE is simply a simple agreement for future equity. It's kind of another deferred valuation security that is used for early stage rounds when folks are not 100% sure where they want to be around valuation. It gives the company some flexibility to, wait until a qualified financing before they price the round. So we will definitely take some time to invest a whole hour finishing up some of these complicated topics. We'll add in another Startup Investing Explained 1.5 in a couple of weeks. And I usually end up having to do this because it's just such a juicy, fun topic. We could talk about this for hours. Which we will make sure that all the attendees today have the opportunity to sign up for. So like I said, please visit 1000angels.com. If you're watching us on YouTube, please like and subscribe for more educational investing content. And if you'd like to ping me, my email is erica@1000angels.com. And look forward to talking to you soon. Have a great day.